Have you ever heard that life insurance agents make huge commissions when they sell whole life insurance policies? That can be true, but it doesn't necessarily mean that it always is true. Today, we're going to look at a very simple example of how commissions work with a whole life insurance policy. What we'll look at is one policy, but set up in 3 different ways, and we'll look at a traditional whole life insurance product. Without getting into the details, what a traditional product is a whole life insurance policy where the premiums are due forever, up until age 100 or sometimes 121. So I can pay the premium forever. But this is the most commonly type of whole life insurance product that is sold. It's also the highest commission whole life insurance product. So we're going to look at an example where someone pays $20,000 per year. And what we'll look at here is a policy with the same insurance company, the same policy or the same product, but set up differently. And you'll see the impact that commissions have on your cash value. So if I'm you, what I want to know is if I pay $20,000 per year, what's my cash value? And then what's the agent commission? My real question is, does the agent commission impact my cash value at all? So policy A, here we go. You pay $20,000, your cash value is 0, but I, the agent, make $18,000. And I'm basing these commission rates based on the rates that I actually receive, based on my company's rates with one particular insurance company. So policy A, you pay $20,000, you have 0 in cash value. This is specifically in the first year, but I make $18,000. Policy B, you pay the same $20,000. You have about $10,000. I, the agent, make $9,000. See what happened there? You paid the same amount of money. We set the policy up differently, and we set it up in a manner where you had more of your $20,000 show up in cash value, but that came at whose expense? My expense, the agent. Then we've got policy C, which is my favorite as a customer. So if I'm getting a policy, this is what I would want. This is typically what we always recommend as well. You pay the same $20,000. You have about $18,000 in cash value in the first year. I make, or any life insurance agent, makes about $2,000 in the first year. See what's going on here? As we increase this, this will be decreased. This is how the product is set up. What I don't like about this is in the industry, it incentivizes agents, me and my peers, to sell products that pay high commissions at the consumer's expense, especially if the consumer is interested in the cash value. Let's take a look at these actual policies on a quick Excel chart. So first, we've got policy A. There's the $20,000 per year. Here, we're paying into it for 20 years. There's your cash value, so a little bit higher than a 0 in the first year. The guaranteed cash value is 0 in the first year, but this example did give him a little bit of value. What's highlighted in yellow is his break-even point. So by year 13, if he paid $20,000 for 13 consecutive years, how much would he have paid? It'd be about $260,000. That's the first year. He has more in cash value than what he's paid in. So he had next to nothing up front, and it took him a long time to get his money back, 13 years before he sees any gain. And then the first year commission to the agent is $18,000. This, by the way, is the most commonly type of whole life insurance product that is sold in the industry because it's the most straightforward. I just buy a life insurance policy, it's about $1 million, and it costs me $20,000. Very straightforward, very easy for an agent to explain and sell, and fairly easy for a customer to understand. But it pays a very high commission and has a very low cash value. A lot of times these policies lapse because the individual that has the policy just doesn't see the value. It takes too long to get their money back. Let's look at policy B. So same exact product here, just set up differently. What do you notice about the first year? You actually have money. You pay in $20,000, you've got $10,000. Your death benefit is close to policy A, but as we look at this, you've got more upfront. You get your money back sooner too. By year 10, you've paid in a total of $200,000. That's $20,000 times 10 years. And you have just about $200,000. By year 20, you've got more in cash value. So you have more cash value from start to finish with policy B compared to policy A. Yet less people are ever shown policy B. Why? This could be a reason. Commission is $9,200 in the first year. So we see the commission is just about cut in half. It's 50% of what I would make with policy B. And then we've got policy C. This is a high cash value policy. I'll also refer to this as a 1090 split. The first year cash value in this example is about $17,000. Depending on the company and product, that could be higher. This one is maxed out, but typically we'll look at a product that gives between $17,000 and $18,000 in cash value in the first year. But as we look at this, much lower death benefit initially. That is one trade-off here. But when we look at the payments, look at this. You get your money back between 5 and 6 years instead of 10 and 11 years or 13 years. So you get your money back a lot faster. When we look at it long-term, what do you notice here? You've got $590,000 in cash value by year 20. That's more than the two options to the left. And again, this is the exact same product with the exact same life insurance company, just set up differently. We're maximizing it for cash value. Commission, $2,200 and change. So just to hit on some bullet points here. Policy C obviously is the attractive one. We've got more money from start to finish. What does this have? It has a minimum insurance premium. So here, he's paying $20,000 per year. His premium is $2,000. And then we have maximized PUA rider. PUA stands for paid up additions. Got about 18,000 going there. A little bit less because we've got what's called term insurance attached as well. My point is we're driving that premium as low as the insurance company will allow. That's typically what we'll do. The cash value is maximized up front. You get your money back faster. You've got the most cash value long-term, but then the agent does make the least amount of money. Now, just to end this video on a positive note, I have zero issue at all with agents earning commissions on life insurance sales. That's how we operate our business. So I never want to come off as saying agents are bad for selling products that generate commissions. But the problem in the industry that we see occur a lot is someone is interested in a whole life insurance policy and they express that they're interested because of the cash value. And they state, I want a policy that has as much cash value as possible. But then they're sold a policy that looks like this, or even sometimes like this, policy A, and told or led to believe that they have a high cash value policy when it's not the case. Then they find out it could have been set up differently. Then they find out what the commissions look like. And that is, I think, a big reason why the industry does have a poor reputation in many ways. So I do hope that this was helpful in terms of providing information around what the cash value looks like, a little bit on commissions. There is more information around commissions. You'll see that the rates will change drastically as we look at different products. So if we look at products that are more geared toward cash value, you would actually see more cash value and much, much lower commissions. And then different companies pay different rates as well. Again, this was meant just to be a basic example. So I do hope that this was helpful. If you'd like to see a video that provides more details around commissions and different insurance companies and such, you can check out this video here. Thanks so much for watching. I hope this helps.